Are you a real estate investor looking to elevate your income, freedom, and lifestyle? If so, optimize your daily performance by downloading our free guide, Raising the Bar, 5 Steps to Elevate Your Habits at elevatepod.com. In this guide, created by yours truly, you'll learn why you do what you do, how to easily institute cues in your environment to trigger desired behavior, directly applicable steps to create a fulfilling future, and much more. Get your free copy now at elevatepod.com and kickstart your new habits today. Your future self will thank you.
Welcome to Elevate, the masterclass where we dissect the elements of exceptional achievement and lifestyle design with a focus on personal growth and real estate investing. Now, here's your host, Tyler Chesser.
Elevate Nation, welcome back. This is Tyler Chesser. I'm so thankful to have you here, and I'm blessed and grateful to be sitting with Stefan Tsvetkov today. Wow. Today, you are going to learn about the advanced data-driven mindset for real estate investing and for wealth building in real estate, because this is the game is changing. It's changing in front of our eyes. And if you want to stay relevant, if you want to maximize your opportunities, today's episode is for you. This is a phenomenal episode, and we're going to go deep. We're going to drill into some new advanced techniques that perhaps you may not be aware of, maybe you are aware of, but I think we're going to expand your mind in such a massive way today. You're also going to learn about really what is that mindset? What is the data-driven mindset for real estate investing, and why is that important? You're going to learn that today. Elevate Podcast is all about mindset, mind expansion, and personal development for high-performing real estate investors. I'm your host, Tyler Chesser, and I'm a professional real estate investor and high-performance coach. It is my job on this podcast to decode the stories, habits, and multifaceted expertise of world-class investors and other experts to help you elevate your performance and lifestyle. Are you ready to take it to another level? It is time. Let's raise the bar today. And I want to thank you so much for being here and listening to Elevate Podcast. We are so grateful to have the opportunity to pour into you. So I just want to thank you for being here on behalf of myself and my team. So thankful. And if you're your first time listening to Elevate, welcome. You are important to us, and it's important that we add value to you every single time. Today is going to be no different. And I want to invite you to pay the fee. If you haven't done so already, go ahead and share this episode with a friend. Share this episode on social media. Just grab the link and send that immediately. And that's all we really ask, is for you to do that. We also ask that you give us a rating, review, and subscribe or follow Elevate Podcasts on wherever it is that you listen to podcasts. That's very important to us as well. And we're so grateful for every single one of your reviews and subscriptions and follows, because you know what, we put a lot into this, and we want to make sure that we continue to add value to you. And without further ado, I want to introduce you to Stefan Tsvetkov, who is the founder of RealtyQuant, a company that brings data-driven and quantitative techniques to the real estate industry. He's on a mission to add massive industry value through education, investment, technology, and analytics. And you're going to see that in real time today. He's a financial engineer turned multifamily investor, analytics speaker, and live webinar host. He holds a master's degree in financial engineering from Columbia University. And during his finance career, he managed over $90 billion in derivatives portfolio jointly with his colleagues. He's been featured on many different podcasts and webinar events, including Invest Up, Best Ever Real Estate Show, Discovering Multifamily, and now Elevate Podcasts. He's also the host of the Finance Meets Real Estate webinar series. And so without further ado, please enjoy this awesome, insightful conversation with Stefan Tsvetkov. Stefan Tsvetkov, how are you, my friend? Welcome to Elevate.
I'm great. How are you, Tyler? Thanks for having me here.
Man, I'm so excited. It was fun to get to know you just briefly here before this conversation. I know it's going to be very insightful. I know we're going to learn so much. And I'm excited to sit down with you and really learn from you and with you. Before we dive into this conversation, Stefan, if you were to describe yourself in the way that the people that know you best would describe you, what would they say about Stefan Tsvetkov?
Great question. They would say an analytical guy, investor, wealth investments, and things like that. So I would say they would say analytical. They would say, I hope most of them would describe me as smart. Hopefully, I don't know. Yeah.
Yeah, I could definitely see them describing you as analytical. There's no question. So you're not hiding that from anyone. And if anybody does any research on you, Stefan, you start to realize the analytics are what drives most of your behavior and the way that you add value to other people. So I'm excited about that. And I'm excited about diving into your expertise today. But give us a sense of a little bit of your upbringing, your backstory. Obviously, I know that you immigrated to the US at a certain point in time, a little over 10 years ago, I believe. So give me a sense of the upbringing, your backstory, and when you came to America and the decision there.
Yeah, so I'm Eastern European, Bulgarian originally. So I grew up in Eastern Europe. I came to the US at 22 for my master's. I wouldn't say immigrated because it was kind of like, oh, should I go back to Europe? What am I going to do? But it was like, I came for my master's. I went to Columbia, actually, in New York, and I still live in New York today. And so I did financial engineering, and then I worked in finance. I used to manage a derivatives portfolio, like a $90 billion derivatives portfolio together with my colleagues. So that was my job before. And at some point in years ago, like several years ago, so I purchased a fourplex to live in one of the units. So kind of like house hacking, story, and like living rent-free, call it, like from the other rents in the building. And so I liked it. I thought, okay, you have leverage, you get some income. There is some potential for a price discount. And so I thought it's a great asset to be in. And in the recent few years, I've been full-time in real estate and a multifamily investor, and building my company RealtyQuant as well.
Yeah, I love that. So that's so interesting because so many folks that I know in the real estate business, especially multifamily real estate business, started in a similar capacity, either by investing in a duplex, a triplex, a quadplex, and either house hacking or just starting small and kind of saying, well, wait a minute, this makes a lot of sense. So give us a sense of that, because your financial background, obviously being a derivatives manager, transitioning from a financial engineer to real estate and multifamily. Talk about the thinking behind that as well. I mean, was it just simply, hey, seeing it up close and personal and the cash flow, tax benefits, and all these things? Or talk about the thinking behind that transition.
Yes, that's a great question. And, I get often asked this question by my father, for example. He would say, why would you study financial engineering and then, go in real estate? So it's a pretty, somewhat unusual. And so my answer to that is, so one, to your point of view, you see the asset, you get you get some intuition from it, be it through your primary residence at first and so forth. But also really, to me, it's, if you think of a finance person's mindset, like, because, you guys focus on mindset, think of a finance person's mindset. So it's arbitrage, it's market inefficiency, it's things like that. And so to me, like, real estate was like, I found over time is like the finance person's kind of perfect playground, if you will. If you overcome some of the physical aspects and some of the hassles and some of the fact that there has to be property management and all that, if you look at it as an asset from a purely like investment characteristic standpoint, it has inefficiencies. You can find properties at a discount. You can find there is income, there is leverage that is extremely efficient, that you can borrow, loads of money for your, call it your business plan. And so from a finance person's perspective, where in finance you would look for, you try to buy something, you try to have any kind of discrepancy, and it's incredibly difficult. And so and that discrepancy is tiny, and you have like hedge fund managers do like extremely advanced strategies to just beat the market by 0.5%, And so you come from that and you look at this physical asset that has all those hassles even, and all those challenges, but at the same time in its investment characteristics, it's so superior and so good and so attractive to an investor. And so that's like what I saw, and that's what made me attracted to it, and realize that, okay, that's a wealth building mechanism. You can build equity gain in a more efficient way. And so I don't need to, keep working forever and saving money or something and investing. So.
Good for you, man. And that is, it's such an insight that you shared about the finance mindset. It's arbitrage, and it's about finding efficiencies, right? It's about finding both of those things. And I think about, really kind of simply, you can boil it down to those two categories. And I do want to dive in further to the data-driven mindset that you've really been able to bring to the forefront, not only from an education standpoint, but also from your own personal investing standpoint, which is really exciting. I think you're going to be able to add a ton of value today by sharing that. But before we dive into that, talk to me a little bit about your real estate investing experience and what that has looked like since you really made that leap as well.
Yeah, absolutely. So being an investor in the small multifamily space in New York City and around New York City, and so that's what I've been doing. So I've been doing my own projects. I'm just starting now on the commercial side, and I built a data-driven system that kind of to do my own lead generation in commercial multifamily, and I can speak to that and some tips, tips for other investors and so forth. But what I've been doing so far is kind of short-term equity gain strategies on relatively stabilized assets that I discover with data in the New York City area. So, for example, it would be, let's say, downtown Jersey City, building for condominium conversion. So sort of pulling all data, finding properties that there's maybe a discrepancy between the multifamily price and its condominium components, call it. It would be another, and just to clarify, I think what's a little bit different from what other investors do, at least in my area and perhaps other places, is it's never been so renovation oriented. It's never been so much physically altering the asset. So my mindset was always, it's an asset that ought to have a certain price discrepancy in SC's current condition. So it was always that I don't need to physically alter it. And this is kind of coming back to the finance discussion and the arbitrage discussion and the market inefficiency kind of discussion. So that was what I was working for with data. So I would pull, let's say, about 6,000 multifamilies, which could be on market. Then I would pull some off-market data as well for multifamilies in the New York City area. And I would kind of price them out on different criteria. Okay, which are the ones that have the highest cap rates? Which are the ones that have, maybe some kind of price discount? Which are the ones that can be worth more through a certain restructuring strategy? And so these are some projects that I have done. I purchased a small condominium building, which was non-warrantable, which was zero renovation, and I raised its appraisal with no renovation at all. And so that was one. I did a 4-unit residential property. I converted it to a 5-unit, call it commercial, where it was literally adding smoke detectors in the 5th unit to make it legal, and it doubled in valuation. So that was another. Then condominium conversions, in kind of expensive markets like downtown Jersey City, Weehawken, and kind of right by New York City, New Jersey, some of the kind of pricier area there for condos. And so those are other strategies. It's been different strategies, but the key is always, to me, has been, okay, if I pull thousands of listings, even if they're on market, you can find the top 0.1%, some real exception. And if you do it consistently, you pull this data every single week, you will find deals this way. And so that has been my approach. So that's kind of but it's really a little bit flips, except the way in which I raise the value of the property has not been renovation. I mean, I could renovate it. Yeah, I could. It's always been an extra layer that I consider, okay, if I make the condition even better, okay, then it's going to be worth that and so forth. But it's not the part where I decide whether I take on the project. It's always been, I want to have the asset in, I never wanted to take on extensive, kind of contractor's risk, where you would depend on that. And I felt it's also not my strength in a purely, just in general, because I can use data better than I can be a construction firm owner or something like that. And so that was just, for me, I felt kind of using my skill set to its more optimal, best advantage kind of
Yeah. And I go back to sort of the earlier part of the conversation. You were talking about efficiencies and that finance mindset. And one of the things about real estate that creates value in many ways is the fact that there are many inefficiencies. And so what you've done is you've applied your experience and your expertise from a data perspective to be able to pull a large pool of properties and identify what is undervalued, right? What's undervalued currently without any sort of renovation requirements. And I think there's a little bit of a counterintuitive or maybe a different than the herd thinking mentality that you're describing there, because most people are looking at deals and saying, how can I renovate a property, either flip it or add value, do the Burr method where I buy the property, I renovate the property, I rent, I refinance and repeat, or I sell. That's sort of the typical mentality of many investors out there. But I would imagine that this approach allows you to pay market value without overpaying on renovations and so forth. And so you're using your expertise to source deals that have immediate meat on the bone, so to speak. So that's really, really interesting. So talk to me about what does that process look like? What tools are you using? What figures are you looking at to be able to identify if this inefficiency or undervaluation exists?
Mm-hmm. Yes, and actually, since you mentioned BRRR strategy and in that, I've actually done a couple of projects where I purchased a property that was kind of a good BRRR project, and I sold it to other investors, and I discovered those with data. But then the thinking on that would be, okay, this is let's say a complete rehab project, and then the thinking is to find rehab projects which are discounted relative to where other investors would. And that's pretty profitable actually, because that's like, again, you buy it. Literally, I did not even go to see those properties. Like they were, it was like if you buy a stock, if you buy like Tesla or something, and I just bought them like a stock literally. And then I sold it in several months and something like that. So that's, so it could be applicable also to like a rehab kind of thing. But again, then it has to be discounted relative in this rehab condition, relative to what other investors would pay. And it's not super frequent. It's kind of hard to find, like there's most of the things are not really discounted in this way. So yeah, so to your question, so what system? So, web scraping is very useful. I mean, I'm not going to hide, So, like there's so many companies out there who, the reality is you have data online and you can purchase some data from different vendors as well. But there is always still so much more that is available online that you can utilize in terms of be it even like various, like market metrics and so forth, or just properties data. And so really for me, it has been like web scraping, sort of the online resources that most, if we look at the on market side, and I know on market is not very trendy with investors because they think they cannot find deals on market because they think it's like only off market, but I think in the residential space, it's actually doable. And so it has been like web scraping, very places like Redfin. I mean, I don't want to, it's probably against their terms of service, but really for own usage, it gives you a lot of depth, gives you a lot of depth into like, okay, what is the unit split, how many bedrooms they have, like square footage and all that stuff. And sometimes it gives actually the rents, the current rents, actual rents that are in place for about 30% of buildings. And so this is pretty deep data that you can utilize, and you can know, okay, what are the cap rates, approximate cap rates in different markets. And they would pull like different rent estimates data as well from various resources and like aggregators online. And so you can kind of compute, all that stuff, and really rent roll, net operating income cap rates, like I said, condominium conversions, like various splittages of the property. If it's a property that needs renovation, what's going to be its after repair value. Another thing that is very useful is, automated valuation models, things like Zillow's Zestimate call it. So it's pretty easy to build your own automated valuation model. So in Python, that's something, that works not great. It's hard to build a really good one. But the one that works like to some extent, where if you operate in illiquid markets, like for example, places like upstate New York are very liquid. And so there aren't all that many transactions going on, and prices tend to be like quite way off. So running an AVM on markets like that can help you discover discounted properties because they tend to like deviate like quite a bit. And so even if your AVM is like not super accurate and it's within 10% only or whatever, it's actually can be helpful in that case. And so an AVM is really like to some of your audience who may be, let's say, technical, is like a machine learning regression where the location of the property is a geolocation, right? It's numerized. So once you have a location that is numerized and you have like all the other parameters that are numerized as well, number of bedrooms, square feet of the property, etc., it really becomes a question of running a regression that's not a simple linear regression, but that accounts for the fact that location has kind of non-linearity to it. That location is something where you can have a rough neighborhood next to a really great neighborhood. And numerically, these are two very close by locations, but they're very different. And so this kind of non-linearity gets captured with kind of more machine learning regressions. And the most standard approach that is used in AVM is called a gradient boosting regression. And that's something that's literally several lines of code in Python that people can do, or they can hire somebody on Fiverr to do it for them. And they would have kind of their own AVM, and they would be able to go and, price houses, in let's say specific zip codes and have some sort of measure and try to find, some, it's not going to be useful for most, but some properties that are way off, let's say, and that's going to be seen at least in that scenario. And that's exactly what you want to find, either way, outliers. And so this is an approach. And AVM has another, just speaking to the techniques a bit. So at my company, I've been working recently on a condition scoring tool for textual kind of like property descriptions, which is like a natural language processing model. Right. So in natural language processing, so one can pull, if you have like, let's say, thousands of property descriptions, to kind of bucket them into, is it a condition of 1, like perfect condition, or 5 needs complete renovation, or 3 sort of like maintained property. And so condition scoring is an important component to automated valuation. And many people have been aware that, this is really what's holding like things like automated underwriting, being able to pull, like thousands and thousands of listings. And there came some startups, for example, a startup in New York called Foxy AI, seemed to be the leader in visual condition scoring, which is a computer vision model for, assessing, like kind of having images of houses or properties and like assessing what kind of condition they're, scoring their condition. Because if you think about it, if you have this kind of automation, it means you're automating human intelligence. So now we all know how hard it is to underwrite deals. So the spirit of like this kind of data-driven thing that I've been doing has been very much to do automated underwriting to make kind of my life easier, in a way. And so, but to achieve that, you need things like vision. You need to be able to read images. You need to be able to read things like reading text, to read descriptions. And that's where machine learning is very useful. And that's where, machine learning's application to natural language processing and computer vision. And that's been coming to real estate to an extent. And there are a few startups doing that. And of course, like some of the bigger private equity firms, they take advantage of, of that, and they have like different data teams and so forth. But those are some things. I can speak to the commercial space as well, where it's quite interesting for off-market properties, how that gets done. And we can touch on that too.
I would love to. And I just have to say, you've covered a lot in what you just shared. And I think it's really interesting. Just to take a step back and to say, there's all of these new technologies and tools that are coming into the purview of real estate investing that, previously there's been this huge just inefficiency across the board in this industry, really in many ways, which has created value. And it's shifting to becoming hyper efficient in the ways that you're describing. And so it calls upon all of us to evolve and utilize the tools and understand what is available at our disposal. So first of all, before we get into the commercial stuff, how are you applying these things? Are you utilizing vendors across the board? Are you building these own machine learning techniques and valuation models and so forth internally yourself? Or how are you utilizing this as an investor yourself?
Yes. I build my own models. But there are vendors to use out there. For rental listings data, there's a vendor called DataFinity. Then for various like owner information, there's like APIs like Melissa API, Estated, places like that. There are a few data companies that cover the real estate space that have really useful, really good stuff that people can do and that are not terribly expensive. So that is definitely a good way. But I build my own models. So I build my own, like I said, NLP for condition scoring. I have my own AVM. I do my own automated underwriting. And on the market side, like I said, my company has been the issuer of market valuation metrics, which is, I don't want to say we haven't invented it because that's something that people can always have been doing. But really the value add that my company had then was calibrating this kind of market valuation measure to the downturns that happened past the global financial crisis. And so really calibrating in a way to say, what is the percentage of predictive power? How much is it predictive? And that's like something that I was never seeing because, people would use like different things and they would quote things like affordability index or, like other measures. And so, but they wouldn't know like how much is it really, what is the variable being predicted? If you have the variable being predicted being, for example, the magnitudes of downturns in various states and various counties past the global financial crisis, then what predicted that? Was it foreclosure rates? Was it volatility? Was it Sharpe ratios, call it like risk-adjusted returns in different regions? And I was looking at those things actually at the beginning of COVID and found, like that essentially deviations from, call it price income ratios, but really if you take deviations from like a regression-based fundamental study of incomes, population, and housing supply, and where prices should be based on this kind of regression, based on fundamentals. And you take deviation versus that on a moving average window, let's say 20 years back, you would have predicted the downturns past the global financial crisis. That's to an 80, actually, and it depends on which kind of region level. If you take something like states, you would predict it very well. You would predict like 85% correlation. If you take it something like counties, then that gets harder. So counties, it's about 75%. So that kind of looks worse. You see it in the data. It's not so, it's not fitting so well. And but again, this is another thing like on market valuation. So I build my own tools like for market analytics. And like I mentioned, on the commercial side, I now started, since I'm transitioning to the commercial space, I've started like doing my own lead generation, kind of building my own marketing lists for that.
Hey guys, just a quick word from our sponsor, then we'll be right back to the show. This episode of Elevate is brought to you by CF Capital, a national real estate investment firm founded by myself and my business partner, Brian Flaherty. CF Capital's mission is to provide property investment and asset management solutions to help investors like you maximize their returns by investing in high-value multifamily communities. If you are looking for risk-adjusted alternative investments in quality apartment communities, are seeking tax-optimized cash flow with appreciation upside without all the hassles of management, you might benefit from learning more about investing alongside our team. You're invited to reach out and learn more about how you can invest with us by visiting cfcapllc.com. We're also currently offering a free ebook called The Bottom Line, 10 Ways to Increase Cash Flow in an Apartment Complex. Whether you're a new or experienced investor, we're confident you'll find massive value in this resource. So go get your free copy today at cfcapllc.com. And now, please enjoy the rest of the show. Yeah, talk a little bit about that. And by the way, I would imagine that it's a appropriate time to mention. I mean, your company RealtyQuant. I mean, if folks want to be able to access some of the stuff that you're talking about, folks can reach out and just go to realtyquant.com. Of course, we'll put links in the show notes as to where the listeners can find that and find you, because from an education standpoint, not only from everything that you're talking about from your own investment perspective, you're offering this type of education to others. And we'll talk more about that data-driven mindset and sort of the shifts required to be able to optimize and maximize these type of opportunities. But I think it's an appropriate time to mention that because, what you're describing here is in some ways a very complex approach, but it makes sense from a high level. So I would imagine if folks want to apply this, they can learn more directly from you and your team. But talk to me about the commercial approach. You mentioned deal sourcing, lead generation. Give us a sense of what that looks like.
Right. Yes. So on the commercial side, I mentioned like some vendors like Datafinity and Melissa API, for example, on the owner's data. So as you know, like commercial multifamily investors, they would use sources like Reonomy, Prospect Now, Yardi Matrix, really, for like commercial off-market commercial properties data. So you would pull, let's say in Louisville, Kentucky, right? You would pull what are the all the different assets, like 100 units, 50 units, 200 units, etc. And so what my company's been working on is kind of and it's probably going to be released in the next 2 weeks, hopefully. It's kind of like an improved version of that, where you don't just have the inventory and then like direct to owner, send direct mail to the owners of those assets, but really it's more of actually modeling those assets. So it's more, and that's achievable via rental listings data. And the reason is, and that's again coming back to the data-driven mindset. If you think that the internet out there just has so much information for you to utilize, and every data point can help you derive insights. And if we take commercial assets and we can really look up in something like rental listings, we can approximately model the income expense sheets on thousands and thousands of buildings where we don't have that income expense sheet. Nobody has given it to us. Because if like otherwise, it would be like, the way you underwrite assets is, okay, you look up some deals, you get an agent, gives you this commercial multifamily, it has, let's say, 70 units, and these are the rents, and this is, these are like the income and expense details, and that can be fairly deep. But then you look at it in terms of, okay, are all those numbers accurate, and are they exaggerating something, etc. But really, this is an income expense sheet, and at that point only your underwriting starts. And what is a data-driven mindset, kind of on the contrary, is when in the preliminary analysis stage, rather than the preliminary analysis just getting addresses and blasting out mail indiscriminately, at the preliminary analysis, you actually have already underwritten those buildings by their rental listings data, and you have looked at, okay, which buildings have rents below market, which buildings have other income components. In rental listings data, places like apartments.com and others, they would actually list what other fees different buildings are charging. Are they charging administrative fees, pet fees, application fees, etc. And one can compare those revenue sources as well relative to the immediate neighborhood. One can look at the utilities and what utilities they're billing to their tenants, etc. And one can also sort of proxy the occupancy based on how many listings are coming out for a property. And so putting those pieces together helps you model NOI at scale for off-market assets that you almost don't know anything about. They're not on the market, they're not even listed, you don't even know what their price is. But by looking at this stuff, you can infer, okay, maybe you can raise the appraisal of this building by 30%, or whichever. And so this kind of analysis helps, do more targeted campaigns. And then in addition, layering over, having this kind of property level analytics and layering over them various zip code demographics and so forth, and pulling your own owner data for really any asset on an address by address basis rather than on a market by market basis is very data driven. And that, if I use this as an example now in my own investment, so let's say I pulled 6 states of data, and let's say in those 6 states, there's 238 counties that meet my filters. My filters are pretty narrow actually, but their properties spread out in 238 counties. Now, if I say that I'm going to filter, let's say, only markets that have at least 20 properties that meet my criteria, okay, then that's going to be only 38 counties. But I'm going to be missing on all those other markets that are in fact the ones where it's the least likely that other people are going to go, because they're the hardest to get to, and they don't have this kind of data, and they're simply not going to do a direct mail campaign in county that nobody has heard of or so forth. And these can be some of the best deals. And so by doing this kind of address-based with own modeling for that asset, if rents are below market, like I said, and other components, you can just like tune your campaigns, and I can be, I would say, like really professional about it, and build your own marketing lists that account for that. Okay, if you have all those different buildings where it appears at least their listings are coming out at pretty high rents, maybe they're quite optimized. Maybe there's no point to send mail to them at this stage, kind of save yourself some of the direct mail costs and so forth. And so that's one thing I've been doing. And yeah, so really the tool that we're releasing at RealtyQuant is a version of that, where it's really going to say, okay, if you have like different markets like Indianapolis or Louisville, Kentucky, or other places, it's just going to say, okay, these are some great commercial assets in your market, and these are the ways in which you can improve them to raise NOI and to raise valuation, to do value add on those properties. You can improve the rents in this way, you can improve the utilities in this way. So it's kind of like giving you, okay, some assets that have value add potential, and also kind of tips and like insights into what are some ways that one can improve them. And this is really from collecting data points online and just, like modeling stuff. So
yeah, I tell you what, man, the listeners are probably salivating at this point, because when you think about understanding at scale the opportunities and what you just described there, to really gain a sense of, hey, where are those opportunities and how can we source them at higher scale? Because, it is a very time intensive process to source deals, to underwrite information, to really absorb that data, to be able to have discussions one-to-one with every single, operator or broker or seller. And of course, it's not like that is completely replaced by this process, but I think what you're describing is a new opportunity for folks to create and unlock new opportunities. And so when you think about this, what you're describing here is an advanced sort of next step. So what tips might you have for folks who are saying, look, the data-driven mindset makes a lot of sense. All of this information is available to us at our fingertips across the internet and so forth. And I'm sure that will just continue to compound. But what tips or suggestions might you have for the investor who's listening and saying, look, I want to go ahead and start making this application in my own business?
Mm-hmm. Great question. I think the first tip is just to understand, okay, what gives you competitive advantage as an investor in, like if you take, again, the commercial example or the residential example, et cetera. And so, and then also, okay, how much is your, if you're hiring people, like underwriting deals, how much is, that worth? Like, are you spending like too much money on people actually underwriting stuff that they're looking at properties, photos, for example, to assess their condition, but you can really run that through an algorithm and have it ready, even if it's not perfect, but to a high degree of accuracy, really, for those condition scoring models. And so it's I guess it's this kind of cost benefit analysis of, what are your current expenses that you're incurring in your real estate business, and in terms of even employees and so forth, and what are, if you do try implementing like a more data-driven approach, what's going to be, how are things going to work there? What vendors do you need to sign up for? It's just keeping an open mind, understanding that gives a competitive advantage, reaching to different data companies, like some of the ones I mentioned here, and just utilizing that. The other alternative is, which could be cheaper, is to an extent, is also one can hire like web scraping companies, perhaps write an agreement where, like if there's legal obligation, kind of goes primarily on them, and things like that. And it's just, web scraping companies or just people on Fiverr who would get data for you. If I look at something like, even in my marketing, because I run a live webinar and we do like events every week. And so at my webinar, to promote that, I would get, like data on prospects, on like leads, like people who would be interested in these things from Facebook groups. And I went and I didn't have the time to write my own scraper. And I went to a guy on Fiverr and he helped me write a scraper, which I ended up then changing myself afterwards. But really a scraper for like Facebook groups and kind of collecting leads of people who may be interested, just on the marketing side. So if you look at something like marketing, it's become extremely data driven. It's literally about pulling various data, being emails data, being other like more narrow, like specific prospects of customers and so forth. And just having an understanding that that's it's a richer approach. That's also it's more automated. It makes you kind of your everyday life easier.
Man, I love what this conversation is really bringing to me is the resourcefulness and the creativity and the astuteness of applying efficiencies in all of these different capacities into real estate. And it's exciting. And I think that any investor can listen to this conversation and understand what is available to us and how this industry is continuing to evolve and those opportunities that are a result of this. One question that I had for you, and I thought it was a really interesting vantage point that you've had over the years, is predicting appreciation in markets and particular assets, as well as predicting downside risk. You've mentioned so many things in this conversation, but talk to me about the methodologies there and what pieces of information and data that you look at to be able to do that.
Right. I mean, on predicting appreciation, now, there's like machine learning kind of algorithms, things that Zero does and other companies trying, at least on a short term, to predict like where price growth is going to be. But the one thing I want to say just to people, like for their like kind of that they can implement easily. If we look at real estate places like Florida, for example, there is very high trend, there is momentum. And so that's an interesting thing. It doesn't need to be this. In finance, they call it weak form efficiency. Are markets weak form efficient? Are basically like historical prices predicting future price? So if you look at real estate, and did this kind of study myself, so one of the tests to assess trend or momentum is autocorrelation. Autocorrelation is just current year price growth correlated with last year price growth. Let's say if it's a 1 year lag. So current year price growth, last year price. So let's say if you have a market in Florida, is last year price performance, how much is it going to correlate with this year price performance? And the answer for Florida, based on like Federal Reserve data, was about 77%, which is damn high. And so if people want to like predict prices, even in those terms, like simply taking like the time series of prices alone and just like predicting that, you can just put it in Excel and do like some kind of forecast. There's the forecast function in Excel actually is a machine learning one, by the way. So one can just do that and like just like predict, and that would probably not be super off. Obviously at the end of the market cycle, when things take a downturn, then it's going to be completely wrong, right? But during the upward kind of trajectory and like while we are in an upward market cycle, it's not going to be so off. So this is like, as far as appreciation, like what I tell people is, if you pick markets that have performed well and that have this kind of autocorrelation, like this kind of trend to them, that is your best bet. If you go in Florida now, it's just going to be like, that's kind of like, that's the dynamic there. And but the other thing, to know appreciation, relative appreciation across markets, you need to know when they were last fairly valued. Because otherwise, if you take, for example, again, Florida, at the peak of 2007, before the global financial crisis, it was very overvalued by close to like 50%, 45%. And so Florida, in a way, you wouldn't know, you have to know like when it was fairly valued to start your time horizon then for your appreciation. And so if you take like the correct time points, then you get like the proper rankings of different markets. And now okay, why Florida is such a strong market where, like all big multifamily investors are and so forth. And you kind of get to see, okay, in the whole eastern half of the US, this is the only booming state. And where others have got like more narrow strength in, let's say, very specific cities, but they haven't really experienced the broad-based growth. And so to such an extent. And so that's, as far as appreciation, really just look at prices, because like people, they also, the other thing, they pull fundamentals. They pull like, what's the population growth, income growth in different markets, and try to infer from that. Well, sure, but try to predict population, to forecast population forward. It's very hard. And so this is already reflected in the price. So if you have prices that already reflect those fundamentals, but then maybe they reflect more than that, and you see that in market valuation, if they have over-reflected stuff, or irrationally increased those prices, So you can, by just doing this kind of, forecasting of the time series, the price time series themselves, you would do better, probably, likely, than actually even looking at fundamentals, because prices simply may not be appreciating according to fundamentals for the time being. And then you would have, on the downside risk, you would have your market valuation, which tells you how much prices have deviated from fundamentals. And then you use that on the downturn. But as far as predicting like this couple of years of price appreciation, is, for me, it's just like I said, it's a trend study. It's like a momentum study. And if you people too much look, I have like in my data, I have like all those other fundamentals. I have like by zip code, all the income growth, population growth, etc. I don't actually look at it much, because this is already reflected in the price. We can see which are the markets that have been strong, that have performed strong. They are likely the ones that are going to be strong again. But the question that comes is also, are they overvalued? What's my downside risk? And this is like where at RealtyQuant, because you mentioned like where, for example, your audience can get different tools. And this is one tool that I've been happy and fortunate that we've put out for people, like in already helping investors not worry and know if their markets are overvalued. Because we have at realtyquant.com, we have like 2,700 counties of market valuations, which tell you if you have Miami-Dade County in Florida, by what percentage is it overvalued or fairly valued or undervalued. And again, that's based on deviation from fundamentals, where this study has been calibrated to the drops past the global financial crisis to kind of what has been most predictive. And so that is another thing. And I can talk to actually, for your audience, I can talk to like some of the cities which I see now as overvalued, and which ones are, seem like to carry less downside risk at the time, things like that.
Yeah, sure. That'd be great. And I think even beyond that, I mean, obviously real estate is hyper local. Every single market, every single deal is unique in terms of the micro drivers that do relate and are correlated to the macro drivers. But I would be curious, your input on what you just shared there in terms of what markets seem to be overvalued currently, perhaps maybe some of those that seem to be undervalued. But I also would love to know, what macro figures are you paying most attention to right now, in addition to what's your crystal ball say, man? Where are we right now in the cycle? Obviously, you've mentioned the global financial crisis multiple times, 2008, 2009, obviously that being a barometer. But where are we now, and where do you see this going over the next few years? If you had to take a stab at and really take a leap of faith here in terms of sharing that information.
Yeah, absolutely. Great question. And yes, so where are we now? Like, what do I see, at least in the data? So here is what I see. It's actually pretty interesting. So what they see is that until the first quarter of 2021 of last year, US real estate was fairly valued. So that was reflected by, because I'm not the only person like doing like those studies. There's a study at Florida Atlantic University. There is a local market monitor. There is also the more global study is a study at Bloomberg Economics by Niraj Shah, which compares like different countries and how real estate is overvalued or not in different countries. So that study by Bloomberg Economics, it had in 2019 and then up to the first quarter of 2021 was showing US real estate is fairly valued. In other countries like Canada, and also in countries in Scandinavia like Sweden, and also Australia, New Zealand, and to some extent the United Kingdom, were actually very overvalued. So if you take something like Canada, like a full-blown bubble, and that's been going since 2019 already. And so that is quite interesting. But US real estate was fairly valued. That was sort of aligning with investor intuition, where we were not, even though some people would say, okay, properties are too expensive, things are really high, I cannot find a deal, et cetera, et cetera. But the reality is there wasn't a sense of like a crazy, like crazy kind of bubble kind of situation. Now, that's changed a little bit or materially, I would say, in the second and third quarter of last year. The way I see this, and just to say what I actually mean, is the following. If we take the states of Florida and Texas, because like I mentioned, computing market valuations and actually tracking it like quarterly and on a historical basis. And so the first time I did this study was at the beginning of COVID, in like April of 2020. But when I did it, I computed the full history of market valuations for 45 years back, like for every county in the states. And so the states of Florida and Texas, if you use this like the big places, big states call it, where multifamily investors go, where, like companies like Ashcroft Capital and, so forth, like big multifamily syndicators go. And so Florida and Texas, they were at 8 to 10% valuation, slightly overvalued, kind of fairly overvalued a little bit. They're trendy markets, but they stayed at 8 to 10% consistently every quarter for 4 years. In the second and third quarter of last year, this doubled to kind of 17, 18%. Now, 17, 18% is not terrible, perhaps, but you don't want to take a 17, 18% downturn, obviously, right? And so, but that is kind of where they went. And so this showed to me like the kind of seemed to me like statistically valid change in regime, if you will, where some southern markets, and to a larger extent, I'm going to mention like some markets to the west, started entering bubble territory. But that only happened in the second and last quarter of last year, because I was at events before. I was at like real estate podcasts and things like Best Ever in 2020, and the narrative was always real estate is fairly valued. That was always the narrative. It was like it's fairly valued, and so. And this narrative changed. And so I was at some point for my own usage, I wasn't even updating this data because I was like, it's always the same. Every quarter it's the same. And so it's no longer the same since the second and third quarter of last year. And so where I would say it's more risky and kind of has entered bubble territory of, let's say, above 20% overvalued are the 5 states of Idaho, Arizona, Nevada, Utah, and Colorado. So those 5 states are over 20% overvalued by this measure. Now, again, if we take Arizona, for example, and why this happened, because you asked like about insights and like some of the kind of, let's say, like things with inflation and so forth. So in Arizona was at around 15% overvalued. It's an extremely booming market for several years. Now, in the first half of 2021, Arizona prices at the state level increased by 17%. Wages, on the other hand, increased by 1%. Now, it's possible that wages are going to catch up. So some of that, I'm hoping that some of this kind of entering a bubble, or how to say, like this kind of overvaluation may kind of slow down, hopefully a little bit, that wages catch up and you experience like stronger wage growth, hopefully. But the reality there is that, so Arizona jumped from like 15% to like 31, 32% overvalued. So that is a bubble as far as that goes. And we've heard like some of the stories, like at the time we heard like about rent growth in Phoenix, where we had, I believe, like 20% rent growth in Phoenix and things like that. And so this is great. Inflation is great for hard assets. But again, if you're a professional investor who knows market valuation, who is not going to be screwed on the downturn, kind of, because that's the key. Because if you know market valuation, then there becomes a question: what if inflation? And that's kind of like the argument for 2021 when you ask me where things are and what I see where we are in the market cycle. It's that in 2021 inflation accelerated, but it's more asset inflation, and there's obviously goods inflation as well. But it's less the inflation of some of the fundamentals that drive real estate, like wages. And so that is not the kind of that is great. You're going to experience great appreciation. It's going to continue, like we mentioned, trend before and momentum. Prices are going to continue booming in Phoenix and in Boise, Idaho, and places like that. But again, your measure of downside risk is going to be according to this, or according to what's most statistically predictive in in regression studies. And so that's so that's what I can say as to where we are in the market cycle, which is inflation accelerated, wage inflation didn't catch up to that. In certain Western markets, the 5 Western markets that I mentioned, and the little bit Southern markets, reach like higher levels of valuation, which is, again, I mean, which is just the first starting point of that. So how many years ahead we have, I don't know, could be 4 years, could be less, I don't know, it's hard to tell. Because if we look at before 2007, in 2002, US real estate was super fairly valued. It's like if this same ratio, if computing it, it's like around 0%, And then between 2003 and 2005, the same 0% or perhaps 10% in those markets went to like 40 and 50% in places like California, Arizona, Nevada, and Florida. And then those same markets by 2005, and then in 2007 only the bubble kind of burst. And then those same markets of California, Florida, Arizona, and Nevada dropped by 40, 50%. And then on the contrary, there were 10 states at the time which were undervalued. Among those 10 states was the state of Texas. So Texas was 5% undervalued. Prices in Texas, as well as the average for those 10 states, dropped by only 4%. So 4% was the drop in undervalued states. So when I did this study before, I was like really impressed that, wow, so real estate is so fundamental that you have the biggest, crash in US recorded price history in real estate. And yet, turns out that's actually only in overvalued places. Turns out in markets like Texas and North Dakota and and other states, states, not markets, but one can look at the more topical markets there as well, right? And which were undervalued, prices dropped only 4%, and 4% was the average income drop in the US after the global financial crisis. So in valuation terms, those states didn't drop. Because if you take like normalized to income, let's say, they stayed the same. And so that was to me like a great observation of kind of risk management and downside risk in real estate. And I felt, okay, in real estate, it's a private equity market where we know property valuation, we know asset valuation well, right? There's appraisals, there's even like automated valuation models, to lesser accuracy, etc. And so we know we can find deals, like the earlier discussion that we had about inefficiency and finding deals. But also, in addition to that, we can know market valuation. That's super valuable. So we can be like Warren Buffett, we can know like all the undervalued markets, undervalued properties. We can never lose money like this. That's like, if you think about it, it is so easy. And it's a private equity market that there's alpha in it. And it is so easy, it's just amazing. And on the market side, it's been stunning to me that because I have so many syndicators in my community, like on LinkedIn and so forth, like people who do like multifamily, primarily investment management. And I find it stunning. They pick properties so well. They know how to find a deal. It's essentially a Warren Buffett approach on the property side. And yet on the market side, this is available. You can simply take things even like price income ratio. That's what I've been telling to people. It doesn't matter. Even if you cannot run linear regressions, compute price income ratios against the historical window. This is going to be a great measure that's going to tell you where to invest, where you have downside risk and so forth, and where you don't need to lose all your net worth after a downturn. It's like, I've had like people like, Rod Cliff at my webinar, people like that, who has like his lectures about, okay, how I lost $50 million after the global financial crisis and then made them again. Okay. But again, there's so many people who experience that. And by the way, on the contrary, there was, for example, Vinny Chopra did his first syndication. He purchased it in 2008. So one would think that's the worst time to purchase a property. And that apparently was a really good deal. It had a very high IRR and so forth. But other than that, the property was a good deal. He bought it in Texas. And it was also a specific county in Texas, which was further undervalued. In the state of Texas, was 5% undervalued. And so he had no price drop. It didn't drop at all. That's it, because he bought in an undervalued state at the peak of, ahead of the global financial crisis. And he saw nothing happened. But but people who are in Florida, people who are in Arizona, people who are in Nevada, they had like 40-50% price drops. And so that is the thing that I've been kind of urging people. It's so easily available. And so RealtyQuant, my company, is one source for that we have it at at the county level for every county, and people can go. And we even offer lifetime updates where they can, they can have you just buy it once and you kind of get quarterly updates for that. So you just forever know where your market valuations are going to go, and you don't need to worry and so forth. So anyways, but it's
Stefan, you are an absolute wealth of information and knowledge, and I just appreciate your insight and the way that you look at the market, the way that you evaluate data, the way that you apply the data-driven mindset, because I think in many regards it can be a missing piece of information, and perhaps the next piece for investors to take their game to the next level. And you mentioned it earlier, it's about wealth building. I mean, at the end of the day, reading this information, scraping this data, allowing this to drive insights and behavior from an investment perspective is really where you can unlock such immense value. So thank you for all of this. And I want to transition into our rapid fire section of the podcast. We call it the Rare Air Questionnaire. It's all about being uncommon. I mean, what you have described today in terms of insight, in terms of scraping, in terms of collecting information and making scalable decisions, and perhaps putting yourself in a position to have outsized asymmetric returns as a result, is uncommon. And so I want to talk to you about a few things, and really more personal development related would be just number one, if you had to point to 2 or 3 of the most impactful books that you've read over the past few years, what would those be and why?
A great question. Well, does it have to be business books? Right?
Not at all. Absolutely not.
Well, I'm not too big on business books. I like The Richest Man in Babylon, books like that, some of the old classics on that. And I mean, in real estate, I like the apartments, what is called Apartment Syndication book by Joe Fairless. It's kind of a useful guide. And, I am not too big on business books, to be honest.
I'm with you, man. Same here. In fact, I don't read a lot of business books, but what are there any others that are non-business related?
Yeah, I read books about nutrition, healthy lifestyle. And I read, a book that I liked was it's called Cure Tooth Decay by Rami Onego, for people into some of the, more, it's a little ketogenic kind of diets or paleo, but kind of more in that direction. But it's just I felt it's a good wealth of information on that. And I like philosophy very much. It's actually one of my hobbies. I'm on Medium. I've done some personal kind of short form philosophy there. So I like that. I read with my daughter. We read some basic philosophy books, and
that's awesome, man.
Yeah.
That's awesome. Well, we will put links in the show notes as where the listeners can find the books that you mentioned. And I love that. I think it's important for us to expand our horizons beyond just real estate. I mean, obviously applying the tactics, the strategies, and the insights that you've shared with us today are critically important, but we've got to expand our minds. We've got to expand our horizons and our perspective, because to be a well-rounded individual, it's not just about optimizing strategies. It's about to understand not only ourselves, other people around us, and design that life, man. So that's awesome. And if you had to point to the biggest way that you elevate your life on a daily basis, Stefan, what would that be and why?
Great question. I moved by the beach recently in New York. I live in New York City, but I moved out kind of a surfing neighborhood by the beach. And so I would say kind of living in nature, being an entrepreneur, where you work from home, you work for yourself, where you focus on equity gain rather than income, where you don't care about income anymore because you're equity gain optimizing. Those have been lifestyle changes for me that have helped me, live a different life from going to a 9-to-5 job and in finance and trying to save your money and things like that. So that has been elevating for me on a personal level, where And the other thing, again for your audience is, and that's where the data-driven mindset comes into play. Like, why do I care about doing data-driven things in real estate where you can make money even without that? Yes, but it's less healthy to one system to not be at the peak of his mental abilities. It's very healthy to be at the peak of your mental abilities. It keeps you in shape. It's like physical exercise, right? And so I found that, okay, once I got in real estate, I found that if I simply do transactions, if I just have to be like kind of transactional, buy this property, sell it, and so forth, I found that I wasn't feeling very good. I felt kind of, I get a little bit depressed, like I was focused, my mind is kind of, jumping around and so forth. And so to me, it's also like some of the data-driven mindset in the earlier discussion that we had has been elevating on a very personal level to simply have focus, to simply have inspiration, simply have things that you like, that you're useful to other people and so forth. And so that has been like the driver for me for that. And I think this is at a very physical kind of level where one needs to use his brain, and if you are good at like other kinds of things, you do that, but you kind of stay optimal and stay healthy and alive like this, that's how it works. So.
That's important. It's very important to have purpose, right? And to think about what's the bigger picture, what's the reason, what's the why behind what I'm doing right now. That's so good. What's the biggest way that you elevate others around you, Stefan?
Yeah, so with like some of those like data-driven, I guess, tools, and we already mentioned. So kind of like offering like analytics, mindset, technology tools to other people. I actually started a course as well on that, on data-driven investing. It's also at RealtyQuant.com. So to kind of teach other people how to do some of those things. So yeah. Mm-hmm.
Yeah, man, I just want to acknowledge you for your immense level of expertise and the way that you're providing that and giving that to other people, the way that you're committing to pushing the envelope in so many different ways to question conventional wisdom in this business. It's refreshing. It's exciting because, this business in many ways can feel like a good old boys club, especially as you continue to rise the ranks. But I think what you're showing is that, we can question conventional wisdom and we can change the way that things are being done and we can take things to the next level. We can elevate. And I just want to acknowledge you for that. I want to acknowledge you for your commitment to excellence, your commitment to expanding yourself personally, professionally, in so many different ways. So Stefan, thank you so much for being on the podcast. The listeners can find Stefan at realtyquant.com or of course on Instagram at Stefan TSFE, or where can they find you on Instagram?
Well, yeah, the best way is realtyquant.com, also LinkedIn, and I have a YouTube channel. So my YouTube channel is called Finance Meets Real Estate on YouTube. We put some good content out there as well.
Perfect. We'll put a link in the show notes as to where the listeners can find your YouTube channel as well. Stefan, thank you so much again for being on the podcast today.
Thank you, Tyler.
Elevate Nation, is your head spinning with opportunity right now? Because mine is. And I'm excited. I'm excited about the tools and the opportunities that are at our fingertips. The people like Stefan in this world who are pulling together so much advanced, different things across the horizon that can help us make better investment decisions, that can help us optimize, that can help us bring efficiencies, that can help us identify arbitrage in our investment portfolio and really across the market. And so it's very, very exciting. So I hope you enjoyed this conversation with Stefan. If you did, definitely want to encourage you to share this with a friend. Go ahead and pay this forward by sharing on social media, grabbing the link, send that to someone else. Pay it forward because that's the only way that we can continue to grow. And it's a way for you to add value to someone else as well. So I want to invite you to do that. I also want to invite you to re-listen to this show. There's a lot there, and you'll obviously learn twice as much if you listen twice. And also, if you have a discussion, have discourse with someone else, what was it that you want to apply to your business immediately? I want you to identify your top 1, 2, or 3 takeaways from this episode and go ahead and take action on those now, because knowledge is not power. It is only potential power. And really the opportunity for you now is to take massive action. So thank you so much for listening today. Until next time, Elevate Nation, thank you so much for tuning in, and we will see you next time.
Thank you for listening to Elevate. If you enjoyed this episode, be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, take this opportunity to elevate your results by taking immediate action on what you learned. For more, visit elevatepod.com.